Yeah, it ended up being a pretty good bill at the end of the day, I think. While we were disappointed that it did not include the 30% depreciation floor phase out. The good elements are that it includes an individual income tax cut. And as you know, everybody knows, there are thousands and thousands of small businesses that, will benefit from that. And I think particularly as, they're competing for workforce and, wages are important. So, while people argue about whether or not money might go back into wages, I think in this environment, it's more likely, in fact, that it will. So, there's good in that. The details are that it's a 7-year phase out, taking the tax from the current 3.23 to down to 2.9, and it does it in like 4 different steps. That right away it takes it down the first step for a couple of years, and then a little more and 2 more years after that, and then a little more 2 more years after that, and then in the 7th year they get to the 2.9. So and I think that's about I haven't seen, they haven't come out with the final fiscal note yet. I was kind of looking for that yesterday, but I think it's going to be right in the range of a $400 million cut. The other piece of significance, a couple other pieces of significance actually, but another cut, if you will, is the repeal of the utility receipts tax that both business consumers and residential consumers have to pay right now. That generates about a little over $200 million. So that's money that kind of goes back into those folks' pockets. So these are taxpayer savings in those 2 pieces. The other is a little more what the Senate wanted all along, sort of causing some of the divide, was to use the bulk of the surplus, the reserves, to pay down the pre-96 teachers retirement fund. And they are doing that in this bill. And the reason that's a good thing is, we have to appropriate, the state does currently a little over $1 billion a year just to make sure that that account has enough to meet its obligations as they come to those teachers. So this takes the payoff date originally a couple of years ago was about, I think, somewhere in the neighborhood of 2037 or 2038. And they've been paying towards that so that they'll meet that kind of balance, the payoff where they have enough money in the fund to meet the obligations in future years. They've been kind of buying that down, and they bought it down enough by the big contributions to the account to take it down to like 2034. And with this latest use or transfer to that fund, it will pay off or meet that obligation in about 2029. And so that $1 billion appropriation kind of frees up another $1 billion a year, every year, once they get to that point. And, so the budget, there's more money in the budget for other purposes. Once they do that, it's certainly a very fiscally prudent step. We've acknowledged that all along. So the Senate kind of got what they wanted there. The House got a lot of what they wanted. The individual income tax was their idea. And the utility receipts tax was their idea, if you want to kind of talk to politics. The governor had initially gone in to deal with the 30% floor. And, and then kind of late in the game actually said, oh yeah, reserves, revenue collections do look pretty good. I think we should do a tax cut. So he kind of, he jumped on board there with the tax cut and the utility receipts tax. And that's what we ended up with.
The 30% depreciation floor has been in place for several decades. It is simply unfair. You're supposed to pay property taxes on the value of the property, But this provision says that even when your machinery and equipment value is less than 30% of its original value, you still have to pay as if it were still worth 30%. That just doesn't make sense. It's, as I said, it's not fair. This proposal is not directed at reducing state revenues per se, like the other provisions that Bill mentioned. It impacts local government, local property taxes. In the House bill, there was a credit mechanism for existing property, as I recall. But I think the challenge we had is that this is a fairly complicated issue, and particularly trying to explain how it really wouldn't impact local government for a number of years. And then after that, it would impact their rate of growth, not their base budgets per se. The folks from the Association of Counties and the Association of Cities and Towns in particular just said this will cause us to lose money. And many legislators, particularly key senators, said, well, we don't want them to lose any money. And so they had a very simple argument, and we had a more complicated explanation of what was going on. In the end, those two associations did not turn out to be friends of the business community. And they failed to acknowledge or refused to acknowledge the fact that there would be economic stimulus effects, that if the 30% floor was eliminated, then businesses would have more resources to buy new machinery and equipment, which would then come on the tax rolls and create jobs that would generate local option income tax. But I think going forward, we've got work to do with sort of rank and file legislators to explain how the impact of this is very minimal, and how, if the state wanted to, it could use part of its excess surplus to offset any revenue loss to local government.